If you think that hard money is just for borrowers who can't get traditional financing, you're missing the point. Because the most successful investors I work with come to hard money, come to me for speed because they can't afford to wait, not because they can't qualify. Hard money isn't a fallback financing option for successful real estate investors. And I know that because I have the same guys coming back to me who have 50, 75, and $100 million portfolios of real estate nationwide. These are folks that understand that with hard money, they can control the timing, they can control the terms, and basically they can control the velocity of the transaction, which means it can help them scale. It can help them decide where and how to allocate their capital most efficiently in maybe more than one deal, maybe in two deals, versus going through a project with traditional financing where you could end up in loan committee 45 days from when you started the application, only to find out that the credit guy had a bad day and he doesn't like your W-2 income. That's not how it works here. And with us, you're in control of the timeline more, and you're using us almost like cash in a way. You know, you're structuring the deal around your project and making it work for the project at hand, not the other way around. You're not working the project into what the bank is looking for, whether it be your own financial condition or the project and the exit strategy itself. So you might have seen in my bio or heard from previous videos that I've been in real estate for 25 years, and I've spent 15 years on the ownership side. I've spent a decade in the institutional underwriting side, doing Fannie and Freddie underwriting. I've done mezz lending. I've touched every level of the capital stack on both the lending and the ownership side of the table. I can say real estate investors today are stacking capital like the pros. They might use hard money on one deal that they need to execute fast, and then they may move to DSCR for a longer term, purchase only type transaction where an interim financing product like a bridge loan doesn't work. They're also out raising capital. They're pairing their own capital with LP money, raising capital from friends and family, and they're looking at the overall capital stack, and they're looking at their leverage with hard money, and they're deciding to come to us because they can raise less capital, which means a larger portion of their capital is debt, not equity, which is cheaper, even in the case where you're using hard money, than it is to pay a return to investors or split profits 50-50 or whatever it may be. To come to a hard money lender like us, when you understand the capital stack, can be advantageous because you're really dissecting your cost of capital and you're using it efficiently, especially when paired with our 0-point program that we have here, which is second to none when you talk speed of money and cost of capital. Our rates, effective rates, are super low and almost in line with banks when you can get in and out of deals in 2 to 4 months, like some of my flippers can. So, the one thing that I'm surprised and I think my viewers should look into is understanding the capital stack, understanding how even the most sophisticated investors are looking at how they're deploying their capital into projects, how they're looking at debt sources. They're using hard money more often than not to execute and to make sure that they're operating in the market they know and that they're getting transactions done in a timely manner. And they're not waiting on banks, which require them to not only bring more capital to the table, but most of the time, more LP capital that's going to further dilute your equity interest and ultimately increase your overall capital cost for the project. So hard money allows you to protect your liquidity because oftentimes bank financing requires more cash down, more cash in the bank, and of course, more paperwork, longer timeframes when it comes to approvals. We'll approve a loan in a day or two and close in 10. A bank may take a week to 2 weeks just to get you approved and then 45 days to close. And then hard money lets you keep more liquidity on hand. I mean, you're putting less down. I mean, we're financing 90% of the purchase, 100% of construction. I don't know any banks that will go that high. I mean, we're looking at the after repair value and the borrower's ability to execute the strategy versus a bank that's going to look at your financing finances and do what I like to call a financial proctology exam on you, asking for tax returns and really focusing on your debt to income ratios versus, again, your ability to execute the strategy. So, when you're looking to hold on to your cash, and hard money allows you to do that. Hard money is going to give you more leverage than a traditional bank can, which could mean that A, you have some money for the renovation that you didn't have before, or B, maybe have other projects that you need to fund or that you want to buy that you can then now use that cash and to diversify and into different assets. So at the end of the day, the hard money loan is going to facilitate transactions like no other financing vehicle can in the traditional sense. And that's going to avoid a ton of delays and a lot of headaches with paperwork and other things that are, intangible. But to have the ability to hold on to your liquidity and even better, deploy that extra liquidity into other assets that can earn you a higher return than sitting in the bank. I think that's why, folks really lean on hard money in the end, because leverage is key to being able to maximize the return on your investable capital. The builders and investors that I know that are growing the fastest aren't using hard money as a crutch. They're using it as a lever. They're able to facilitate transactions because we're able to approve loans in a day and we're able to close in 10 days. With traditional financing, that time frame can look more like 10 to 15 days to approve, 30 to 60 days to close. So they're able to move forward and make deals happen faster. They can make same-day offers. They can effectively entice the seller to accept their offer above others that have traditional financing attached to them. So what does that do? Now they've closed quick. Now they can start the project faster. So they're moving forward. As a flipper, they're quickly getting the property demoed. A couple days after closing, a builder is starting to clear the site and move forward with the foundation. A lot of the times, folks can get through 30 to 45 days of a project before the bank could even close. And that can mean massive difference in terms of timing the market. So the other thing is they have the ability to scale without deploying all their capital in one project. They can deploy their capital into a couple of different projects. So they're able to diversify and they're able to potentially get a couple projects going at once, which can keep their costs down and ultimately maximize their profitability. So they're not reactive, they're strategic in choosing to go to hard money versus traditional bank financing for those reasons. If you're ready to stop thinking like a bank borrower and change your mindset to thinking more like an active investor or builder whose focus is to maximize capital efficiency, let's talk. I'm a loan officer in the hard money space. I work for asset-based lending and they're a sponsor of the video. So I really appreciate the support. Thank you for the likes and the subscriptions, and I look forward to the next one.